I'm Charlotte McLeod with investingnews.com, and here today with me is Alain Corbani, head of mining at Montbleu and manager of the Global Gold and Precious Fund. Thank you so much for joining me. Great to have you on.
Thank you very much, Charlotte. Always a real pleasure. Always.
Really nice to be catching up with you. It seems like we're always talking toward the end of the year, heading into the new year, and here we are again. We're going to get into lots of details about what's going on with gold and the markets, but I thought we could start with a little bit of a look back at 2023, look at what happened to gold this past year, any takeaways that you have and would like to share with investors.
I will start by telling the viewers that it's when we talk about gold, we need to understand real rates. We need to understand where the U.S. currency is heading. But now that I said it, it's even more important to make it to see it in a very simple, straightforward way. We can complicate the approach to understanding how gold behaves as much as we want. But if we want to draw a very simple, clear picture for the viewers, we'll just say that each time the Federal Reserve moved from a tightening phase to a pause in interest rates, meaning stopped increasing its rates, each time, this happened in 2001, this happened in 2007, it happened again in 2019. Each time the Fed moved from a tightening mode to a pause mode, gold went up. So the call that we've had for the last 18 months to say rates are going on, we have reached a peak in interest rates, we have reached a peak in inflation, we have reached a peak in the U.S. currency, was based on the fact that the Fed was going to move to a pause mode. And the fact to be on a pause mode does trigger a higher gold price. And this is exactly what happened in 2023. So, but it wasn't, of course, as simple as that, because until, all the first half of 2023, nobody knew where inflation was heading. And you had all sorts of bets of positioning, whether inflation was going to go above the 5%, was going to decelerate, reaccelerate. It was all over the map. And to make it even more complicated, in Q3, you had an outstanding growth rate of the American economy. So this made it even more difficult for the common investor to see clearly. But the clear vision was to say a restrictive monetary policy will affect the growth in the economy and will force the Fed to pause and ultimately to lower its rates. And this is exactly what is happening, or at least what the market has started to price in the last 2 months of 2023.
Okay, I really like that. I like starting with that simple message. And of course, we're going to now complicate it, but really good to put that out there for people to understand the main point right away. And so maybe one thing that we can look at. So we talked about that theme of the Fed peaking rates last year. And we have seen this past year, they went a little bit higher. The Fed had more gas in the tank than I think a lot of people expected. What are your thoughts on why that was? Why was it able to raise rates higher than people thought it might?
Because the economy was strong, because the unemployment rate was really low, because consumption was very, very, very solid. And these are normal reasons. And who could blame the Fed? They did the job. They did what they had to do. But I just remind you that back in July 2022, 18 months ago, there was this the July 26 or 27 FOMC meeting, and back then, the participants mentioned that the nominal Fed fund rates, they were at 2.5, 2.35 to 2.5%, were close to their longer run neutral rate. So already back in July of 2022, the Fed was telling you above 2.5%, we are starting to be in a restrictive monetary policy, which means that we are going to impact the growth, meaning we are going to weaken the economy. For any level of federal fund rates, that would be above 2.5%. But all the subsidies, all the fiscal stimulus, all the monetary policies that were extremely, extremely generous during the COVID did impact in a much stronger way the strength in the economy. And this is why the Fed had to be a little more aggressive than they thought themselves back in July 2022. But Charlotte, before you ask me the next question, but since July 2022, since the Fed said that at 2.5, the federal fund rates are close to their longer run neutral level, let me ask you a question. How well did gold perform since July 2022?
Definitely, it's done very well. We've seen
Exactly.
gold, yes.
Exactly. It was up 18%, more or less. Gold mines were up 18%. And you know what? The S&P 500 was up 18% too. So nothing is, there's no coincidence. The fact is that we all knew that with a lag, we all knew that above 2.5%, we are definitely in a restrictive monetary policy. And no matter what, ultimately, this will impact negatively the growth of the economy. And it took us exactly much longer than we thought, but we got there. And if you look at all the federal, regional Federal Reserves banks and their forecast about the growth of the economy in Q4 of 2023, the best forecast is 2.2%. You have St. Louis Fed, you have Cleveland Fed, you have the Atlanta Fed. I mean, the range goes from negative growth to plus 2.2% versus the 5% we had in Q3 2023. So there is definitely a deceleration in the growth of the economy, and this is due to the tightening monetary policy that is impacting the consumption.
Okay, so that gives us a good idea, I think, of how we got here with the Fed, where we're at now. It looks like we're at the top of that hiking cycle finally, although, of course, the Fed is not going to tell us that itself. So if we look forward into 2024, we're starting to hear a lot of different predictions on what happens with the Fed and rates. So I want to check in with you and see where you think rates are going to go in next year.
The market is extremely reactive, respondent, and violent. In the U-turns, it can take in forecasting the direction of rates. But as it stands today, the market is telling you that the Fed will cut its the Fed fund rates by 5 or 6 times. 6 times 25 BPs, that's about 1.5%, more or less. But the projection of the FOMC are telling you that they are going to cut their rates 3 times, but not 5, and definitely not 6 times. So from being very conservative, the market now is becoming very proactive and thinking, the Fed will have to be much more aggressive lowering its rates than what it's telling us. So, and the reason is there are two possible reasons. One is a weaker economy. The economy is going to slow down more than what we expect. In that case, there won't be a soft landing. That's what everybody would like to see. Or, and this can shock a lot of people when I'm going to say it, or we could move into a deflation period. And I didn't say that for the sake of saying it. I was just looking at the forecast of one regional central bank, and basically, if we annualize the inflation numbers of the Fed of Dallas, the November months annualized would show negative deflation. And if we take the last 6 months or the last 12 months of inflation, we see that we are below the 2% target of the Federal Reserve. So there are some metrics that are telling you that could induce you to think that the core PCE at 3% is actually maybe the wrong figure to look at. And maybe the next numbers would be much weaker than the 3% or the 2.2, 2.1% that the market expects for inflation 2 years down the road or 5 years down the road. So if the prices go down at an accelerated pace, maybe the Fed will, not maybe, the Fed will definitely have to be more aggressive cutting rates. So these would be the main two reasons why the Fed would be more aggressive.
Okay, so we've got potentially moving forward into 2024, maybe we've got the soft landing scenario. That's the one you mentioned. Everybody wants that one to happen. Or we could have deflation, as you explained. So are you leading further to one direction or another in terms of what you see coming?
I will respond slightly differently, Charlotte. I'm looking at some metrics. I'm looking at the inverted yield curve. A lot of people talked about it. It was all over all the media channels. But I'm the part of the old fundamental school, and an inverted yield curve reverting sends you a signal. And it sends you a signal that the economy is weakening, and it is weakening. So that's number one. I'm looking at the disinflation trends. I remind you that the 2-year inflation expectations moved from 4.5% to 2%. And this is sending you another message, which is consumption is still strong, but it's weakening. And there is a lag. Let's keep in mind that there is a lag. I'm looking at the leading indicators, and they are telling you that they are deteriorating. And I'm looking at the job openings. Yes, they are. The numbers are higher than those in 2019 pre-COVID, but they are weakening. The number of job openings is weakening every month. So these are figures that you must incorporate in your analysis. Then you have inflation. The last figures about inflation, well, they are not driven by supply; they are driven by demand. So, which means if demand is going to weaken, suddenly you will have less inflation, and suddenly the forecasts of the Federal Reserve of Dallas have a more significant weight in your reasoning. I'm looking at real disposable income, and it's flat in the last quarter. It was flat. So you either spend with your savings, or you stop, or you reduce your spending. This is another signal that is telling me that we shouldn't expect much more strength in the economy. So all this, and this is why the market now is more aggressive in forecasting lower rates down the road than the Federal Reserve. And this to me makes sense. And for those who think that the Fed has been a little too conservative, or that the market has been too aggressive and that there is a rebalancing that needs to take place, I would say be patient, because right now the numbers that are being printed demonstrate that we are in a weakening economy and not in a re-strengthening economy. So I would definitely think that we are in a weakening economy, and this will require lower rates, and the market has priced this in. But I don't think that the market has been too aggressive. I really don't think, because this goes back to what I was telling you earlier, Charlotte. I was telling you back in July 2022, the Federal Reserve mentioned that neutral longer run rates, and for them it was 2.5%. So the market now is pricing Fed fund rates at the end of 24 at 3.75, 4%. So it's still way above the neutral longer run rate of 2.5%. So rates can go lower and will go lower. That's obvious to me. And they will go lower because they will respond to a weakened economy and probably weaker inflation numbers.
Okay, I think that gives a clear idea of what you're thinking there. And I want to throw one more thing into the mix, which is the US dollar. So you mentioned before, we've seen the peak in the US dollar. And I was reading just the other day a Bloomberg article that was saying this is looking like it's going to be the worst year for the dollar since 2020. So I want to get your thoughts on the dollar, what it's looking like in 2024, if we're going to see that weakness persist.
Yes, we are. And but keep in mind, we are really pragmatic here at Montbleu. So keep in mind that the US currency will only weaken when the economy will require a competitive currency, and when inflation will not be a problem. Inflation is starting not to be a problem anymore. Maybe we are fast forwarding quickly, but probably 3 months, 6 months down the road, we will all know that inflation is not a problem anymore. That's number one. If inflation is in control and if the economy is weakening, this is when corporate America, the Treasury, the Federal Reserve, they will all ask for a weaker currency. And this is when we're going to have it. And the fact that the US dollar has started to weaken demonstrates the fact that we are heading into this direction. But if we have suddenly higher inflation numbers or a stronger economy than the present forecast, we might have, a hiccup in the weakening trend of the currency. And this is normal and this is to be expected. But the dollar will weaken when the economy will need some stimulus to revive its competitiveness.
I think it's also worth mentioning this is going to be 2024 will be an election year in the US, and there are certain trends that we see in these election years. So would that have any bearing on these events going on in the economy?
We used to say in 2023 that history demonstrated that the Federal Reserve never, ever increased its fund rates in the last 18 months before a presidential election. We used this statement just to validate our scenario that rates were going to go lower and not higher. And this is what is happening. And now, to make this statement that the Fed will not increase its rates, it's granted. Now it's granted in December, at the end of the month of December 2023. This is granted because the market has accepted this statement. But the market wasn't sure about this statement 3 months ago. But the reality is that the Fed stays neutral or cut its rates before a presidential election, the 18 months prior to a presidential election. So don't expect the Fed to play against the economy in the next 12 months. And there's one little example I gave to the investors of the fund when I talk to them. I will always remember Elizabeth Warren, the senator, U.S. Senator Elizabeth Warren, and she was criticizing Jerome Powell, and she was telling him, your policy is to put American people out of work. This is what she was telling him. That was a year ago. So do you expect that the chairman of the Federal Reserve is going to take any responsibility for putting people out of work in the next 12 months before the presidential election? Obviously not. So the Fed will be neutral, the Fed will be supportive for a stronger economy, and the Fed will be supportive for the equity market in general.
Okay, so I think that gives us a great idea of what's going on in the US, the landscape there. So let's go back to gold. So definitely we have gold at historically high levels right now. There's excitement in the industry, but people also have, I think, a lot of questions about what's coming next because they've seen gold come up here and go back down. So when you look forward to 2024 against the backdrop that we've been discussing, what do you see happening with the price?
The market will need to digest the fact that the 4%, 3.5% Fed fund rates expected by the end of 2024 is a very conservative target. The market needs to start pricing in the fact that the Fed is not going to stop at 3.5%, that the Fed will go much lower than that. And this is what the Fed did each time it started a cycle of lowering rates. So imagining a second that the economy can sustain a 3.5%, 4% 10-year rates when it's indebted to levels not seen in 4 decades, when inflation is not an issue anymore, is not realistic. So the Fed will lower its rates and will continue lowering rates because the economy is going to continue weakening. And this is what the market needs to know for gold to continue performing well. So we need a Fed to become much more friendly than what it has been so far in 2023. And gold will do fine, and gold will do well. And and let me remind you the statement we made at the introduction, that each time the Fed move from a tightening mode to a pause mode, gold goes up by 50%, 50. So I expect gold to hit $2,500 in the next 18 months, 2 years. No reason that it doesn't happen. None.
Okay, and if we're talking about gold, we've got to talk about the gold stocks as well. People are also wondering when we're going to see those start to perform a little bit better. What are your thoughts there? What are the catalysts that might spark some more interest in the gold mining stocks?
It's what is interesting is the perception and the fact. The perception is gold mines are performing poorly, very poorly. But let's again repeat what I said earlier. Since July 2022, when the FOMC made the statement about the longer run neutral rates, gold was up 18%, 17%. Gold mines were up the same way, 17, 18%. My point here is to say those gold mines did as well as gold, even though they had to fight strong, historical strong headwinds, i.e. inflation. They had to fight inflation on all fronts, whether it was coming from the supply side or whether it was coming from the salary side. So this, and they did as well as gold, so but in a much more volatile way. So they could have been up 40% and down 10% and another up 20%. So all what the investors are remembering is I lost 20%, I lost 30% from the peak of the mini cycle of the last 18 months. They forget that over the last 18 months, their investment in gold stocks were up 15, 16, 17, 18%. So we have tons of reasons to be harsh on gold mines, on gold companies, but I must say that they could have done more poorly than what they did. And the fact that they performed as well as gold is a disappointment, but not when you incorporate the hurdles they had to meet and run up against. And inflation was a total the expenses, that items on the expense side that were historically in nature, high in nature. So would have I liked to show our investors that the fund did better than gold, that billion? Of course, but wait a little bit, be a little more patient, and assuming I'm right in my forecast on inflation, assuming I'm right on our forecast on rates, which are going to go lower, in that case, cost inflation, will not become a number one issue for those gold mines anymore. And the leverage that you expect from this investment class will suddenly deliver. So what I'm saying is that patience in this case is required, but and you can be disappointed expecting at least a performance twice as high as the one on billion for gold, the gold mines, but it's just, to me, a question of time, and to look at the inflation of the costs today is as if I'm looking with a back view mirror. This is the past. This is the past. This is not the future. If there is any inflation or an expense item that could be an issue and is an issue and is identified and priced in, it's salaries. And the market has already incorporated a 5% increase in salaries for 2024, exactly like the market in general. I mean, salaries are up, yes, and gold mines face the same dilemma, but the supply side is not an inflationary source of pressure anymore.
One more question on the gold companies. So you've told me before the Global Gold and Precious Fund you have a pretty broad mandate. So you can look at different sizes of companies. You can look at companies across the precious metals sector. So I'm wondering right now, what types of companies are you seeing the most opportunity in at the moment?
The weakness, our weakness has been we identify the trends, but we're usually a little bit early in identifying trends. So I've always said, and I repeat it, that gold is cyclical, and the correlation between gold and gold mines is very high, about 80%, and therefore gold mines are cyclical. That's number one. And in a cycle, you have two phases, and we have entered the second phase. The first phase is we restructure, we focus on strengthening the balance sheet, and we focus on profitability. And we get rid of as many marginal assets as possible. That's phase one. Then we move to phase two. And why do we move to phase two? Because the mandate is changing. With a higher gold price, the mandate of those companies is changing. The shareholders of these companies change their requests. Suddenly, it's not anymore, I want you to focus on financial discipline. It's, I want to see not only the financial discipline, but I also want to see some growth. So, and I will not pay any premium until I see a growth coming in the pipeline. And this is exactly where the fund is positioned. The fund is positioned in companies which could provide growth to other companies, or companies which have a profile of production growth. So, and that would be about 50% of the fund. So we believe in growth because growth has always been the theme of the second phase of a bull cycle for gold.
Okay, I think that makes a lot of sense. That's everything from me today, unless you had any final advice or words that you wanted to leave investors with as we're heading toward the new year.
No, Charlotte. I think we have covered all the topics around gold and gold mines, but common sense. This is really what I would like everybody who's listening to us to focus on. Common sense. Too much debt, weakening economy, weaker savings. This means lower rates. This means lower inflation, and this should be an environment favorable for gold. And the cyclicality of the gold sector is telling us that we haven't been close to the peak of this cycle. So a few more years ahead of us before we hit that peak in this bull cycle, and then it will be time to review our strategy. But in the meantime, we maintain the course.
Okay, very good summary. Thank you so much for coming on to talk about everything that's going on with gold, the U.S. economy. Really great to hear your thoughts heading into the new year.
Thank you very much, Charlotte, for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Alain Corbani with Montbleu. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.